Stop whatever you're doing and pay attention to what the silver market just did. Because this is not really about one metal, it is about control. Over the last few days, with silver whipping around $90 an ounce and gold holding above 4,600, the main futures exchange did what it does when it gets scared. It reached for its biggest lever. It jacked up margin requirements and rewired the formula so that the higher silver runs, the more cash you have to park just to stay in the trade. That move is supposed to suffocate leverage, flush out speculators, and smack the price back down. It is the tool that tells big shorts, relax. If this gets out of hand, we can still bring it to heel. This time it barely moved the needle. Silver dipped into the low to mid-80s for a moment, then snapped straight back into the high 80s and low 90s, as if the rule change were nothing more than an irritation. When you hit the emergency brake on a major monetary metal and it hardly slows, you are not looking at a normal pullback. You are looking at a warning. It tells you the move is no longer being driven mainly by fragile borrowed money. It tells you serious capital is starting to care less about paper contracts and more about actual metal. At the same time, governments are drowning in debt and quietly taxing savers through inflation. Once you cross that line, the next stages are very predictable. Shorts, who thought the rulebook would protect them, start to panic. Futures positions creep closer and closer to real delivery. And people in the mining and refining world start using a phrase you never want to hear in commodities: force majeure. What you just watched is only the latest round of a very old pattern. For decades, silver traders have operated under the same shadow. The exchange has always leaned on margins as its favorite weapon when price runs too far too fast. What matters now is who that weapon actually hits. It hits the trader who borrowed to be in the position. It hits the fund that is already stretched on futures. It hits anyone whose exposure lives and dies on a daily margin call. It barely touches the buyer who turns up with full cash and says they want delivery. It does not stop an industrial user who cannot shut a factory line because the exchange is nervous. And it does not scare the patient holder who is not using borrowed money and can sit through swings. So when that kind of margin move barely dents the price, it tells you something simple. The bid in this market is no longer dominated by fast money leverage. The center of gravity has shifted toward people who either need the metal or intend to own it outright. And if you're short and counting on the rule book to save you, that is a dangerous place to stand. Your whole approach assumes that every big rally can still be broken on command, that bad news will land on the screen and obediently knock price down. In a controlled market, that is how it works. Raise margins, force liquidations, reset the chart. In a market that is slipping out of control, bad news stops feeling like a hammer and starts looking like a discount sign. Each attempt to knock the price lower turns into a sale notice for buyers who have been waiting on the sidelines. At that point, you have to stop staring at the headline price and pay attention to the plumbing underneath, to how traders are choosing their delivery months. In a comfortable market, the habit is to push exposure into the future. You hold a contract, you roll it before delivery. January becomes March. March becomes May, and you keep kicking the can because you trust the system to be there later. In a strained market, that behavior flips. Traders start trying to move closer to the front of the line. They roll inward instead of outward. They pay more to sit in nearer months. They accept higher costs just to be closer to the point where real metal changes hands. That is what it looks like when a futures claim stops being treated as good as the metal, and people begin to ask a sharper question: will the metal actually be there when I ask for it? Once that question is in the air, the structure of the paper market begins to creak. A futures contract is not just a bet on price. It is a promise that delivery is possible, and the system only runs smoothly as long as most players do not test that promise. When more and more of them decide they want the thing rather than the promise, you hear the strain in tighter spreads, and bids crowding into the near months, and in the willingness to pay extra, simply to cut the time between the contract and the truck. You do not need a conspiracy theory to explain any of this. You only need to see that in a stressed market, time itself suddenly has a price. Serious players are acting as if later is a risk because the fundamentals make delay dangerous. Start with supply. A large share of the world's silver does not come from big dedicated silver mines. It comes out of the ground as a byproduct of lead, zinc, and copper projects that are run for those metals, not for silver. Even with silver near $90, you cannot just flip a switch and double output. If copper or zinc prices do not justify it, the miner is not going to tear up a long-planned mine schedule just because silver is screaming. Silver rides in the passenger seat. It does not drive the truck. Now put that beside demand. Silver today is both a work metal and a refuge. It is built into solar panels, electric vehicles, high-end electronics, data centers, and medical equipment, while at the same time investors are using it as hard asset insurance against inflation, government budget stress, and currency erosion. You end up with a tough mix, mine supply that cannot easily flex, industrial demand that keeps grinding higher, and another wave of buying from investors who watch stocks and bonds wobble even as the S&P 500 sights near record highs around 6,900. In that kind of world, high prices do not automatically fix high prices. They shine a light on the weak points in the system. On top of that, big buyers are moving closer to the source. In theory, metal flows neatly from mine to refiner to wholesaler to exchange vaults and then to everyone else. In the real world of 2026, that tidy chain is being cut short. Large industrial users and powerful financial players do not want to trust that inventory will always be sitting there on public exchanges, so they do what powerful players always do. They move closer to the tap. They lock up production directly at the mine or the refiner. They sign long-term deals for output, and they quietly reserve metal that never shows up in headline warehouse numbers. On paper, total global production can look fine, but the pool that is actually available through public markets keeps shrinking. You can have enough metal in the world, yet not enough metal where shorts need it when they need it. That is how you end up with a strange picture. Steady-looking mine output, tight visible inventories, and a futures market where short positions are leaning on a smaller and more political pool of deliverable metal. This is where the phrase force majeure enters the conversation. In legal language, it means we cannot perform under these conditions. In commodities, it usually appears after a strike, a serious accident, a breakdown in transport, sanctions, or violent weather. But it can also appear when the system is under so much strain that honoring old promises would mean breaking something else. If a miner or a refiner has promised metal at much lower prices and now looks out at a tighter market and far richer terms, the temptation to search for a legal escape route is obvious. Most companies will bend over backward to avoid that step because force majeure is reputational napalm. But the fact that people in and around the silver trade are even talking about it tells you how tight the mental map has become. We are not yet seeing front page after front page filled with confirmed force majeure notices from major silver producers. What we are seeing is the backdrop that makes that language feel possible: rapid moves in price, tangled supply chains, elevated geopolitical risk, and a market where shorts depend on everything running smoothly if they want to escape in one piece. If those pipes and routes fail even for a short time, paper shorts do not get to wander out and magically find new metal. Their real exit is to buy back contracts at whatever price the market demands, and that is how a squeeze stops being a line on a chart and starts ending careers. There's one more piece almost everyone underestimates, and that is confidence. Markets do not run only on cash and contracts, they run on belief. For years, the belief was simple. The exchange has this under control. If things get too wild, it will step in and calm everything down. But when the referee hits the emergency button and the scoreboard barely changes, that belief starts to die. Shorts begin to ask what else might fail, and they picture the moment when they are forced to cover into a runaway move because physical delivery is no longer something they can count on. That alone is enough to trigger new buying, not because they suddenly want to own silver, but because they are afraid not to. That is why failed attempts to smash a market often mark the beginning of the real move, rather than the end. They flip the psychological script. Back in the late 1970s, when the Hunt brothers tried to corner silver, the exchange eventually pulled a very blunt version of the same playbook. It kept raising margins until it hurt, then changed the rules outright and forced long positions to sell. It did stop the move, but only after the system admitted that the usual tools were not enough, and it was willing to rewrite the game while it was already in progress. Jump to 2011. Silver pushed toward $50 an ounce, and margin increases came in waves, each one wrapped in the language of risk management, but all aimed at the same thing, making it steadily more expensive to stay long until the rally finally cracked. That episode burned into the memory of anyone who thought the market would be left alone once it ran too hot. For an even more recent example of what happens when the plumbing cannot cope, look at the London Metal Exchange nickel shock in 2022. Nickel spiked in a short squeeze, prices went straight up, and the exchange did not just raise margins, it canceled trades after the fact. Imagine being right, winning your bet, and then being told your profits do not count because the system cannot survive paying you. These stories are not history for its own sake. They show a clear pattern. When key metals move in a way that threatens large, entrenched positions, the people running the system reach for tools far beyond letting the market clear. They can raise margins, stop trading, rewrite the rulebook, even erase entire days of trading if that is what it takes to protect the structure. What is different now is the backdrop. Silver is climbing in a world loaded with debt, short of truly secure supply and wired together by instant information, so the tricks that worked in 1980 or 2011 may not land the same way in 2026. The fear has flipped. Instead of long players being terrified of margin calls, short players are increasingly worried about being trapped on the other side of buyers who will not back down. At current levels, silver is not just another price on a chart. It sits just below a line everyone can see, the move into three figures. $100 is not just a number, it is a headline. It drags the story into the mainstream and forces ordinary savers to ask why this is happening. Once that question spreads beyond trading desks, money moves differently. Fast traders show up, small investors follow, and institutions that have ignored silver for years suddenly want some exposure. The result is not a smoother ride, it is a rougher one, with sharp spikes, hard shakeouts, and mood swings that run from euphoria to despair in a matter of days. Messy does not mean false, it means the room is filling up. The part that really matters for you is what silver is measuring. Right now, it is acting as a live test of trust. Trust in paper claims, trust in the pipes that connect contracts to bars, trust in the idea that you can always turn a futures position into metal without drama. You have already seen what that looks like in practice. Margin moves that do not kill the rally, traders dragging risk closer to delivery, inventories that keep slipping, and people in the trade talking seriously about legal clauses like force majeure. Taken together, those are signs that trust is thinning out. If enough players decide that only metal in hand truly counts, the paper market is forced to adjust to the physical world, and that kind of adjustment is rarely gentle. At that point, silver stops behaving like a small trade and starts behaving like a diagnosis. Beneath all of this, the margins, the curve, the legal language, sits a larger pressure, the buildup of global debt, and the slow move from genuinely free markets to managed outcomes. Governments carry record promises that they cannot service at honest interest rates without blowing up their own budgets. So rather than declare default, the system leans on softer methods. It keeps rates below inflation as long as it can, steers captive buyers into the bond market, and lets rising prices quietly eat away at what is owed in real terms. Economists give this a polite label: financial repression. In plain language, it means savers, pension funds, and anyone stuck in so-called safe nominal assets end up paying the bill through lost purchasing power. Their account balances go up on the screen while their actual standard of living slips behind. In this kind of environment, hard assets stop being just one more slice of a portfolio and start becoming a quiet form of protest. When silver breaks out at the same time, bond yields and inflation do not line up in any honest way, the message is simple. The market is saying it does not trust the numbers on the screen to protect people from what is happening underneath. That is why this move feels different from a random spike in a small cap stock. It is tied into everything else that looks stretched: government promises, central bank balance sheets, property markets, even the cost of rolling over corporate debt. When faith in the currency and faith in the rulebook both start to fray at once, metal stops trading like a dull raw material and starts trading like a verdict. You do not have to agree with that verdict, but brushing it aside means ignoring one of the few places where physical limits still talk directly to financial prices. In a world built on layers of derivatives, buybacks, and clever engineering, that direct line is rare, which is why silver's behavior matters far beyond the people who hold coins or bars. If you are skeptical, that is healthy. It is normal to look at a chart that has gone almost straight up and say, this looks like another bubble that will crash like the others. We have all watched hype waves come and go, from crypto surges to meme stock frenzies to housing booms. But the useful question is not whether silver can correct. Of course it can. The question is what the world looks like after it does. In a pure bubble, once the air comes out, the story dies. When the price collapses, almost nobody needs the asset for anything essential. It was belief and borrowed money doing most of the work. Silver does not live in that world. Even if this move runs too far and snaps back hard, the planet will still need silver in solar panels, electronics, medical equipment, and all the other industrial uses that do not care what a commentator says about the chart. Governments will still be wrestling with too much debt and too few painless ways to deal with it. Central banks will still be trying to walk the narrow line between inflation and instability. So yes, volatility cuts both ways, but underneath the swings, the basic reasons people are reaching for metal do not vanish just because the price has a bad week. That is what most casual bubble talk misses. And it is why serious players focus on what breaks during a sell-off, not just how far the line pulls back. From here, a few signals matter more than any headline. One is how the market reacts the next time someone tries to lean on it. If there's another round of margin changes or new rules and silver still refuses to roll over, that is further proof that the old tools are losing their bite. Another is the shape of the futures curve and the behavior around delivery months. If urgency keeps shifting toward the front of the line, it tells you that later is losing its appeal. A third is inventories and logistics. If metal keeps draining out of visible vaults faster than it comes in, and if you start seeing more talk of delays and constraints in shipping, refining, or mining, that is when legal language like force majeure starts to feel less theoretical and more like a live risk. The last is the wider backdrop. When you see gold at record levels, silver high, and stock indices such as the S&P 500 also near their peaks, you are looking at a world that is buying hard assets and paper assets at the same time because it does not fully trust cash or policy. Put all of this together, and a clear pattern emerges. First comes pressure through margins and rules. Then come the failed attempts to smash the price. Next, the futures market turns cautious and pulls closer to delivery. After that, physical strain and legal questions like force majeure begin to hang over the system. Finally, the paper price jumps in a hurry to catch up with the physical reality. Most people only wake up in that last stage. You now have a clearer view of the stages that lead into it. So let me leave you with 2 questions. Do you believe the next big move from the exchange will genuinely break this rally, or will it simply hand determined buyers another discount? And if silver has already taught the market that the old panic button does not work, what do you think the next lever will be? More complicated paper rules, or a scramble for real metal? If you have thoughts, put them in the comments. I do read them. And if you want to keep tracking this pattern as it unfolds, subscribe so you do not drift through the next phase half asleep. Whatever label you prefer, short squeeze, supply crunch, or a deeper reset in pricing, what we are watching in silver right now does not feel like just another passing commodity story. It feels like something much more important, pushing its way into the open. Thank you for watching, and please subscribe and like the video. Nothing in this documentary is financial advice. Always do your own research and consult a licensed professional before making financial decisions.